If you don't have W-2 income, it's hard to get a loan. So I turned to Jay Vorhees at JVM Lending for some answers.
Lending environment changed so much after the 2008 mortgage meltdown. Prior to 2008, there were a lot of options for borrowers like that, especially if they had a lot of assets or good credit, or especially if they had both. They could get extremely competitive loans. The default rates were almost non-existent as long as there was a large down payment. But what happened is a lot of lenders got too loose with their guidelines and started to fund loans with very low down payments and no income verifications. And a lot of those loans, as you know, went into default, and Congress overreacted and overregulated. And now they literally prohibit many of those types of loans. And Fannie Mae, Freddie Mac, and very conservative jumbo loans are the only games in town when it comes to getting low rates. So it's very frustrating. And so I even blogged a few years ago about a baseball player who was making $10 or $12 million a year. I think you saw that blog. And the poor guy had to be run through a ringer just to qualify for a loan, even though his debt ratios were under 3%. They were astoundingly low. And that's kind of the nature of the lending environment right now. And it's very sad and very frustrating for a lot of very well qualified borrowers who have a lot of assets, or a lot of equity, huge down payments, and a lot of other factors that would otherwise make them very, very strong borrowers, but they just can't verify income in the traditional manner. And that's what you're kind of alluding to. And verifying income in the traditional manner refers to using tax returns and or W-2s and pay stubs to verify income. So the only alternatives right now are what are called non-QM loans or non-qualified mortgages. And borrowers can use those loans to get decent mortgages, but the rates tend to be about 1% to 3% higher than the rates that you would get with a Fannie Mae loan. And what they can use for as an alternative to providing tax returns are either bank statements, where we just take the last 12 months of their bank statements and add up their deposits and divide by 12, and that's their income. We can also do what are called asset depletion loans, or we can look at their assets and use that to help them qualify for a loan. One of our more competitive loans, you need about the equivalent assets that are equal to about the size of the mortgage to qualify. So it's not that much assets. So it's a viable way to get a decent loan. And there's some other options too, such as using only rental income on a particular property to qualify for a loan. Those loans are called DSCR, or debt service coverage loans. But we can find a loan for almost anybody in any circumstance as long as they have at least 20% down right now. And frankly, about 80% of the buyers who do take those loans come back to us in a year or two to refinance into a better loan, because we tell them what they have to do to qualify for a conventional. Particularly self-employed buyers or borrowers, we can show them what kind of income they need to show on their tax returns in order to qualify, and they often have enough income that they're able to do that. They just haven't in the past to avoid paying taxes, to be quite honest. But if they're willing to pay the taxes, they can show more income and then qualify in a year and then get a much better mortgage and refinance out of the non-qualified mortgage.
There's no shame in strategies to reduce taxes
Absolutely.
until you get denied for a mortgage.
Well, sometimes it makes more sense if you're saving 50 grand a year in taxes because of the way you're structuring your income. It's probably worth it to keep on doing that. So even though it ends up costing you $3,000 or more in mortgage interest, I'd still rather save $50,000 a year in taxes. So it kind of depends. So when these buyers get frustrated because they can't qualify, well, they have to consider how much they're probably saving in taxes. Three advantages to non-QM over hard money. One, a slightly smaller down payment. Two, lower fees. And three, slightly lower rates.
Honored to get this brain dump from you.
Likewise, great talking to you.